I'd like to call the Board of Administration meeting to order for March the, what are we, the 9th? March the 9th. Time flies. Do we have a quorum?
We have a quorum.
Any non-agenda public comment?
We have one.
I have a speaker slip.
Yes.
All right, Mr. Hall.
Thank you, Mr. President and board, fellow board members. Dave Hall, President of the Retired Fire and Police Association, former board member. And I'm here for a couple of topics and a couple of reasons, one of which is to recognize Dave Crow, who was at one time a board member and a fellow retiree. And Dave Crow serves as a really good example of where we are is not where we were in terms of the wonderful things that have happened with SDCERS over the years. And one of the things that I would like to express is thanks to staff. Board primarily deals with policy and so forth, and what staff does is they have to carry these policies out on a day-to-day basis, as you well know. And it's not always under the most pleasant of circumstances. And some of my fellow retirees get rather anxious or nervous or fearful or very challenging to deal with in light of some of the issues that they see as looming issues that impact their lives. And as a result, they contact members on staff at SDCERS. And I would like to give special thanks to Marcel, Sandra, and Cynthia for dealing with these kinds of issues that few of you know about, that are very, very difficult to deal with. A lot of our members are dealing with grief. They could have a passing of a spouse and so forth, or other issues that they're dealing with in their lives. And then they have to deal with SDCERS staff. And a lot of times the conditions aren't ideal. I got to tell you, I was on the board a number of years ago, and the evolution and the change, and a lot of it through Mark Hovey's leadership, and I'm sure it's going to be continued on with Greg, the involvement in terms of how to deal with some of these issues has been remarkable, and for that we are very, very thankful. But we also do owe a debt of thanks and gratitude to Dave Crow, who recently died, as you know. His services are tomorrow, and if anybody's going to attend his services, make sure you wear a Hawaiian shirt, because that's just about all that Dave, or he wore pants, but he did wear a Hawaiian shirt. So again, if you are intended or inclined to attend, it's El Camino tomorrow afternoon at 3 o'clock. And even though it may be raining, Hawaiian shirts are acceptable. Thank you for providing me this opportunity.
Mr. Hall, thank you very much. We're going to, at the end of the meeting, we're going to hear from Tom Sullivan a little bit about Dave Crow, and we will adjourn in remembrance of him. Thank you for your kind remarks about staff. They are right on, and we're all very grateful to staff. And I think the members are very grateful to staff for the service that they provide. So thank you. With that, I'd like to move to the unless there's any other non-agenda public comment, and I see none, we'll move to the approval of consent agenda items A through D. Okay, and do I have to move those? Roberta moved it, no second required, is that right?
Usually you move it, but it's fine given there's a second now.
There is a second, but Tom, you're unnecessary.
There.
All right. Anyway,
Only his wife is qualified to make that determination. I got to tell you. That's
all right. So unless there's anybody that wants to pull anything, we're ready to vote.
Ready to vote?
Shouldn't let that stand like that. That was just terrible.
All votes are in.
All right. So we carried 9-0 the 4 consent items. There are only 9 members here, but it is a quorum. So let's move then to the consideration and action of items pulled from consent agenda. There is none. And I'd like to call out of order now items 10A1 and 10C1 and invite Steve Voss of Aon to come up to the podium and address those 2 items on a combined basis. And I think this is going to take us about 15 or 20 minutes to go through and Steve, you'll take questions and comments as we go?
Yeah, absolutely. Please, please do ask questions as they come to mind. We'll go ahead and pull the item up on the screen. Let you get where you need to be on your monitors as well. So, good morning. I'm Steve Voss from Aon Hewitt Investment Consulting. We're the board's investment consultant and help on things like asset allocation, investment program structure, manager monitoring, and other topical things. We work very closely with Liza and her team and present and work closely with your investment committee on a quarterly basis. We had a very good, very lengthy, healthy discussion yesterday about a variety of things. What I'd like to do today is take a quick look back at performance for the past year, tell you how the program did relative to risk, relative to benchmarks and other measures, but then importantly, take a look ahead and try to give us a lens to think about how the investment program might perform on a go-forward basis. So we'll spend some time on what we call our capital market assumptions and the asset allocation that we think is necessary in order for you to continue making benefit payments into the future for your participants. And then we'll spend just a few minutes on some structural discussion items, how you get that asset allocation. We tabled part of that discussion yesterday for lack of time, and we also didn't have our chair of the investment committee, and we didn't have our CIO. So those are some important weighty topics that we think that we would like full participation in. So we'll hit some of those items when we come back in May to meet with your investment committee. With that, let's go ahead and jump right in. We'll look at the market value of the investment program for the past year. If you look at the far right-hand side, you can see that the investment program started at $7.2 billion and ended at $8.2 billion. There were net benefit payments of roughly $104 million. And there was growth in aggregate of $1.1 billion for the 1 year. So a pretty spectacular number when you think about it in the grander scheme of things, the $1.1 billion of aggregate
So
growth.
we made $1 billion last year, and we spent $100 million on benefits.
Correct. And there were contributions that came in, so that $100 million is a net number, net of contributions and benefit payments. That equates to a roughly 15.4% rate of return. I'll show you that in just a minute. That's what we would consider, quote, an outsized rate of return as to what might be expected on a go-forward basis. Not shown on the exhibit, but I think it's good to reflect back even further. If we go back to the low of the financial crisis in March of 2009, the corpus of your investment program had a balance of roughly $3.2 billion. Again, compare that to where we are today at 8.2, that's $5 billion of aggregate growth, net of all contribution and benefit payments. So it's been a pretty spectacular period. Your patience with asset allocation, your patience with your investment structure has rewarded you quite nicely with some strong rates of return. And these are the rates of return that you've achieved. So looking at quarter, fiscal year to date, 1 year, and some longer time periods, you can see that 15.3% rate of return that I just referenced. That is a green bar shown in the 1 year column. That is a net of fee investment return. So it's the return that the trust fund actually generated after all investment costs were taken into consideration. What's most noteworthy about that? Well, there's two things that are noteworthy about that. One, just the sheer magnitude of that number. 15.3 is a spectacularly strong number. But the value that was added on top of that. So these are the decisions that your investment team makes. These are the decisions that your investment committee makes, coupled with your investment managers, your external investment managers, that added 90 basis points of value on top of what you would have been able to achieve if you were to simply passively invest your assets. So 15.3% return and 90 basis points of value added makes for a very good, strong calendar year. We can go look out over the 3, 5, 10, and some longer time periods. Strong returns on an absolute basis for both 3 and 5. A little bit of weakness on that 10-year, that 6.1% return. As I'll show you in just a minute, that is fairly close to what we think your return will be on a go-forward basis, much lower than what it has been. I think I've used this expression before with the committee and likely the board. We've been reaching into the future and pocketing rates of return today, so therefore we should not expect such strong rates of return on a go-forward basis. Any questions about the returns? Let's, I think another important measure of performance is to look at it on a risk-adjusted basis. Returns are fine, but it's nice to know how we've done relative to volatility. And here's a standard exhibit that's shown as industry best practice. It's a risk-return diagram for the last 5 years. And what we're plotting is on the vertical axis, returns, and on the horizontal access risk. The ideal spot would be to be in the northwest quadrant of this particular exhibit. You can see the very small font. You are the blue square, the total funds performance. That is your risk return relative to your policy benchmark that I just showed you on the previous page. So you can see that you earned a return 30 basis points greater with a very slight higher level of volatility. Then we have another data point, the triangle on the right-hand side. That is a passive representation of 78% global stocks and 22% bonds. And that says if we wanted to give all of our money to Vanguard or State Street or BlackRock and simply index everything, what might we expect to generate in terms of a return? And that's what that data point shows. What's noteworthy there is the far higher volatility that was generated from that passive representation compared to your investment program. Well, why is that important? We're compounding rates of return in a negative cash flow environment. So we want to protect and we want a lower volatility rate of return so that we can have a strong dollar value, stronger corpus at the end of a period of time. So lower volatility actually accrues to greater wealth for the pension trust over time, an important component. What this tells us also is that simply diversification has worked. For the cost of private equity and infrastructure and real estate and other asset classes, it's worked quite well over this 5-year period.
Can you describe just, Steve, the total fund policy benchmark, where it comes from?
Absolutely. So it's the crux of what we talked about with the investment committee yesterday and what we look at once a year. It's your asset allocation, the mix between U.S. stocks, non-U.S. stocks, fixed income, real estate, private equity, and other sub-asset classes. The board-approved mix, and then there's a benchmark associated with each one of those set asset allocations. I'll show you an exhibit in just a minute that shows the exact weights, but I would consider it an institutional best practice to use such a policy portfolio and to use standard indices as you do here. Any other questions about the risk return exhibit? Let's move forward then. So we've looked backwards. Now we're going to attempt to take a look ahead and see what we might expect in terms of asset allocation on a go-forward basis. So why do we have these expected returns? They're a needed component for us to do an asset liability study or an asset allocation study. And you may recall in 2016, working with your actuary, we did an asset liability study and we came up with a mix between stocks and bonds that we thought would make the most sense. What we do then on a once-a-year basis, yesterday and then here today, is reaffirm that. Does that mix still make sense? And then how might we refine the mix between different asset classes? The pieces that we need to be able to do that are a look ahead at expected returns for stocks and bonds. And that's what the exhibit on slide 6 illustrates here. We show our most current capital market assumptions, and I will note that these are for a 30-year time period. And then we reflect back and we show what our cap market assumptions were 1 year ago and then 3 years ago. And we do that just to try to get some context on how the markets have changed. What we might expect 3 years ago is different than what we should expect now. I won't go through all these numbers, but what I will say is compared to what you just saw in terms of your past performance, these are a lot smaller. These are a lot lower expected returns. And that's a result, in fact, of, again, that reaching into the future, pocketing the returns today that we think would be accrued to institutional investors over time. Let's go ahead and look at, and Mr. Chairman, this gets to your question on what your policy benchmark is. That's shown on the next slide, slide 7. These are the weights that the board approved for the different asset classes. And what we've done here is calculated an expected return with our current data that I just showed you on the previous slide, what that was a year ago and what it was 3 years ago. This is 30 years worth of data, or 30-year look forward. We had a pretty good, robust discussion yesterday about different time periods, and we can calculate this over shorter time periods, say 20-year period, and we could calculate over a 10-year time period. So last night I took the opportunity to calculate what your total fund expected return would be on a 10-year period, and we came up with a number very similar to the 6.55%. We came up with a number of 6.37. So that would be taking a 10-year cap market look forward, what we might expect the investment program to generate. A question that you might ask is, well, how did we actually do in the past 10 years? Now let's look backwards again. That was a policy return of roughly 6.3. So we're roughly in the right neighborhood. 6.3 is what you had earned. And on a look-forward basis, 10 years, 6.37 is what we expect things to be on a go-forward basis. Let me pause there. That's an important number, but let me pause there for just a minute and see if there's any questions about any of these numbers on slide 7.
I have a question. What's the risk-free rate projection for your 10 and 3-year forecast? Is it in the footnote?
It's about 2.4%.
For
That would be the cash. That would be a cash rate of return.
and the inflation is
2.2. Yeah, low compared to pardon me.
for 10 years or for 30?
2.2, I believe. 2.3 is our current 10-year assumption. So far less than what inflation was during, say, the 60s, 70s, or 80s, or even 90s. But we do think inflation is going to be more subdued on a go-forward basis. The one thing that I failed to mention at the outset, we revisit these capital market assumptions on a quarterly basis, and then we work with your investment team and ultimately you and project this on an annual basis. So it's not a set it and forget it type of analysis. We're mindful of what's going on in the capital markets today. And where interest rates are and so on and so forth. And those are the things that help inform us to what go-forward expectations should be. Any other questions? Okay. Let's just talk about what that number means. So the number I draw your attention to, again, on the previous slide, that's 6.55% go-forward 30-year rate of return. What does that mean? Well, it means that it will help you hit your actuarial assumed rate of return of 6.5, but it also means that you need to take sizable equity risk within your portfolio. You can't go out to the bond market and defease your liability with conservative fixed income instruments. We need equity risk within the investment program.
As long as our target remains our assumed discount rate is 6.5%, we need to do that. But if we
Correct.
were to change our policy and lower our discount rate, we could take risk off the table and volatility off the table?
That's correct. That's correct. There's not a lot of great places to go right now in terms of trying to achieve rates of return, right? The fixed income marketplace, our go-forward expectation for intermediate bonds is about 3%. We're in a world of diminished return expectations is probably the best way to say it. But very true, if you were to lower your discount rate even further, you'd be able to take your equity risk lower to achieve whatever it is that your lower discount rate would be. Very true. Given where we are today and given the needed return of 6.5, equities remain important. What do we need to do with that? Well, we need to diversify our equity risk. We can't have all of our exposure into one sliver of the economic global marketplace. Instead, we want very broad exposure. And that's something we spend a great deal of time with your investment team talking about. Global equities, getting broad exposure to those asset classes and doing it in a very efficient way. And we'll talk a little bit more about that in a few minutes. So our summary commentary on your investment asset allocation is that we think it's appropriate. We think it's appropriate given your current discount rate. We think it's appropriate given the liquidity environment that you face and given the cash flow and the contributions that you have. That's the crux of the summary that we would bring to you today. So this schematic just illustrates the continuum discussions that we have and the type of analysis that we do on a periodic basis. So once about every 3 years, we do an asset liability study, or as circumstances change in the capital markets or your own circumstances change. Once a year, we look at asset allocation. That's what we're doing now. And then once a year, we also review structure. These types of things shouldn't be changing immediately or quickly. We don't see changes in asset allocation or structure. Instead, we make methodical changes kind of thoughtfully and slowly over time in concert with your investment team, bringing ideas to you and then implementing them in the investment program. I've covered a lot of this already, but this is all very new to you. These are reminders that the importance of asset allocation. It is the single largest driver of the success of your investment program over the long run, is the type of asset allocation that you set. It will determine whether or not you have enough money at the end of the day to pay benefits. And when we look at asset allocation, set asset allocation, there's a variety of different risks and different factors we're looking at. One is the long-term expected return, downside inflation protection, the cost of getting and achieving this asset allocation, ensuring that you have the right resources and budget appropriately your investment team, both internally and externally, the flexibility that you place within your investment policy statement, and the delegation of authority that you give to your investment team to be able to execute. Those are all the different components that we look at and measure to come up with what we think is the right asset allocation for an institutional investor like you all.
Steve, you've got a 78 to 22 ratio between risk-seeking and risk-mitigating assets. A lot of us who aren't on the investment committee may be familiar with the notion of a 60-40 mix of stocks and bonds or equities and
Yeah.
cash or something like that. But you're using a little bit different terminology, and frankly, if it were a stocks and bonds mix for a retiree, 80-20 wouldn't exactly be the conservative way to go. So I'm just curious if you could shed a little more light on the difference between what people might think of as a stock to bond ratio and what you've got here.
Yeah. That's a great question. It's a complicated question. There's a lot in that in terms of what individuals need to retire on and what an institution like this pension fund is needed. So it should be thought of very similarly to that 60-40 mix that we all hear in the the popular press or from our personal financial advisor. It's just that very simple mix of stocks and bonds. And we define it a little bit more complicated here. And then we refine that measure to be a little bit more precise at 78-22 instead of 60-40. But what this represents is the trade-off between, there's like a natural tension. It's the tension between needing rates of return to be able to defease your liability over long periods of time and also being able to withstand shocks to your investment program. So mitigating that downside volatility, such as the dot-com period from 2000, 2001, and 2, or the financial crisis in 2008. So that's why we came up with the 78-22, different from what an individual might need. An individual, depending on their age, their quote amortization period. Individuals have finite lives. The life of your pension is probably a lot longer than some individuals. So that's why there would be a difference between what we show here and what we might hear in the popular press on a 60-40 mix.
Thank you.
You bet. Any other questions or comments? I'm not going to go, there's a lot of text on the next handful of pages, but what this shows is it's kind of a walk down memory lane, and those of you that have been involved in the investment committee have experienced these and worked with us to achieve many of the things listed here. But these are the different initiatives and some of the things that we've been doing over the past 5 or 6 years. There's been a pretty heavy emphasis on cost containment, bringing costs down as low as we possibly can, getting access to good investment managers, taking risk where we think it's best rewarded. And the high-level summary is we've been trying to get our market risk, our stock and bond risk, very, very cheaply, using index funds, keeping costs remarkably low, and then spending our risk dollars, if you will, and our fee dollars and our intellectual time on things like alternative investments, private equity, real estate, and infrastructure. And it's those things that we think will be accretive long-term to the investment program performance. So the next handful of pages basically say that in a lot more words than what I've articulated, than what I just stated, or than is needed to be stated, pardon me. If it pleases the committee, what I'd like to do, or the board, what I'd like to do is talk about 2 items that we brought yesterday for action, 3 items that we brought for action. We'll just go through those. Any dialogue, of course, be happy to take, and then I believe there will be a vote or an action item on these items. So 2 of the more important asset classes that you have are private equity and infrastructure. They're important because they generate strong returns, they provide strong levels of diversification, but they're also important because they're illiquid and they have long lives. So we want to make sure that we get these assets right. We want to make sure they have the right mix, we have the right advisors, we have the right benchmarks, and so on and so forth. So the investment committee and your internal team has spent a great deal of time on these 2 areas. Yesterday, we brought forward 3 recommendations that are more administrative in nature. They're not changing the approach that we take to invest in the particular asset classes. But one was to decouple your private equity and infrastructure from a singular asset class to 2 asset classes. We'll talk about that in just a minute. To change the infrastructure benchmark to something that is more representative of the direction that the program will be going on a go-forward basis. And then the third item was to move to what we call a peer universe for private equity. And I'll briefly talk about those things in the next couple of pages. First, on the decoupling of infrastructure and private equity, they were brought together a handful of years ago for simplicity and as leverage with the discussions that your external advisors, Grosvenor and Stepstone, would have in the marketplace. they're going out to the marketplace with a larger pool of assets, it gives them a little bit more scale to negotiate terms, et cetera. But when we did that coupling, we lost track of the ability to clearly express weights, asset allocation weights, and performance of two asset classes that have distinctly different risk-return patterns. And that's why we're coming to you today and seeking that to be removed or decoupled so that you can see clearly, your investment committee could see, and our performance reports would illustrate performance for private equity distinct and separate, and performance for infrastructure distinct and separate. This is an exhibit that we've shown the investment committee a couple of times now. It takes the infrastructure asset class and it just looks at it on a risk continuum basis. I won't go through all the exhibit here, but your external investment advisors for infrastructure have been operating on the more right-hand side of that distribution, seeking kind of higher return-seeking investment opportunities. We'd like to move that back towards more of the center of the exhibit to be more core-like, and that does call for a change in benchmark, which is the second recommendation that we brought forward to the investment committee. The current benchmark that we use for infrastructure is the same benchmark that we use for private equity. It's an annualized 10% rate of return. Not uncommon in practice to use such a return, but we don't find it to be best practice. Instead, what we like to see for infrastructure is an inflationary rate of return plus some type of a premium. And the recommendation that went forward yesterday was CPI plus, I believe it was 4 to 5. And that item will be put up on the screen here in a few minutes, and we'll talk about that. The reason that we left some room is that we want your your chief investment officer to opine on that and to have her thumbprints on that as well. I think that's a critically important aspect. And then the third and final recommendation, again, since we're decoupling infrastructure and private equity, let's take the opportunity to look at the private equity benchmark and make sure that it's doing, quote, the right work for us. Right now, we're using, again, an annualized 10% rate of return as a primary benchmark, and then a 10% return of the 10-year return of the S&P plus a premium of 300. Again, those are used in practice. What we think is a better benchmark is to take a look at what your peers are doing in private equity. So look at a database of investment managers investing in private equity and derive the median return of those peers. This is a useful benchmark on a shorter time period, say a 1, 3, or 5-year period. And so we want to create this as your primary benchmark. We want to keep a long-term benchmark as a secondary benchmark that looks at a passive mix of U.S. stocks and non-U.S. stocks plus a premium. We picked 2/3 U.S. and 1/3 non-U.S. stocks as it is the habitat where your private equity investors or private equity managers are currently allocating capital to, on a 2/3 U.S. and a 1/3 non-U.S. basis. The 3% premium is to take into consideration the illiquidity of the asset class and the higher risk of the asset class, that investors should be rewarded and compensated for locking up their money and taking more illiquidity. Those are the three recommendations. I think what might make sense is for me to just finish this presentation. I only have a couple more slides, and then we'll go back to those, and then you can take a vote. We just talked about two asset classes that are illiquid, and I mentioned earlier that the importance of liquidity of your investment program. You are a negative cash flow fund. Many of your peers are, most of your peers are as well. We want to be able to measure liquidity very carefully and thoughtfully so that you don't get stuck in long-lived private equity and long-lived infrastructure assets and not able to make benefit payments when those benefit payments come due. So on a regular basis, we monitor your liquidity. We don't just look at the types of investments that you have. That's what you see on this page. But we're also looking at the contributions coming in, the benefits payments coming out of the investment program. So we're taking into consideration what we think is the kind of the real cash flow characteristics of your investment program. And then what we've done and what we showed the investment committee yesterday is stress test that in different environments. We had base case scenarios, black skies environments, recessionary environments, to see if your conservative cash and fixed income investments would be impaired and create a challenge for you to make benefit payments. And the short answer is, over the next 10 plus years, we don't see there to be an issue if contributions continue to come in as they are expected to and as they're modeled in your asset liability study. So just an important comment on liquidity. And then I'll close out on one last item, so that once we figure out our asset allocation, we want to figure out how to get that asset allocation. So that refers to structure. And structure is the implementation of asset allocation. We weren't able to get through all the materials yesterday. There was a lot of content, and we tabled some of that for the May meeting. One of the items that we're going to be taking a closer look at, however, is the mix between U.S. stocks and non-U.S. stocks, making sure that we have the right mix of those asset classes taken into consideration, our experiences with the managers that we have, but also our go-forward expectations of returns and risk in those two areas. So I plan to spend more time with your investment team. We plan collectively to come back to the investment committee in May with some ideas or recommendations on how we might change that U.S., non-U.S. mix in stocks. And I'll stop there to see if there's any questions or comments that you might have.
Yes, I have a comment. Thank you, Steve. Yesterday, we had a pretty lively discussion on asset allocation and performance and the technique to forecast the asset allocation. We use a 30-year, which is your recommendation. This is foreign to me in all the analysis that I've done in other places. We use a 10-year. I have not seen a 30-year employed as aggressively as here. And I think that we owe it to ourselves to take a look at a 10-year and compare it to what we've been doing. I'm also interested in comparing that 10-year forward forecast with what actually happened over the last 10 years and see if we can do better. The other concern that was raised, that I raised, is the mix between domestic investment and foreign investment. You heard Steve say that it's 2/3, 1/3, but I'm more concerned on the equity side than on the fixed income side, and so the imbalance is a little less there. I'm seeing in other circles, other investment committees, where that is moving more towards a balance, 50-50 on the equity, U.S. versus foreign. And I would like to engage with you, Steve, as well as the investment team here to try to answer these questions in prep for the next board meeting.
So yesterday we were in the investment committee, we were short both our chief investment officer and our investment committee chair. So we made the decision to move the manager and George's questions to the next meeting so we could take some time with it and get those done. So our motion today is going to be to approve items 1 and 2. I'll read the motion when we're ready, but if there's no further discussion.
I'm in the queue on this. I want to say that I concur with the decision of the committee chair and the committee to defer this kind of discussion until Liza and Carol can be there, and I'm sure George agrees. So excellent points, and I think we need to have further discussion of this in May and come back to it. But Steve, if you'd like to address the issue of 30-year versus 10-year in the context of this fund, I would invite
Sure.
you to do that.
Sure. So we did take the opportunity to calculate 10-year data last night, and I have numbers that you can draw, or you can write on your workbooks in front of you. So the expected 10-year go-forward rate of return based on your current asset allocation is a 6.37%. That compares to the 30-year of 6.55%. So it's less. The actual, if we were to look in the rearview mirror of the passive mix between stocks and bonds that was generated, that number is 6.3%. So fairly close, actually very close in the grander scheme of things compared to the go-forward 10-year and the look-back 10-year rate of return.
But all of this is highly relevant to the board in trying to evaluate what is the appropriate discount rate to set on a going-forward basis, and we absolutely need to come back and have that discussion again and keep having it. At the same time, I am curious as to whether, Steve, you or Aon is in the position of advising funds like ours or even private funds on what is an appropriate assumed rate of return and an appropriate risk allocation or portfolio allocation and risk portfolio
Yeah.
for an organization, because we tend to, I'm afraid that what we do is we say, okay, well, we pick this number, you manage to it, and nobody ever stops and says, why did we pick that number? It used to be in the pension fund world that it was 100% in bonds, and pension funds achieved a sufficient return from that bond portfolio with very little risk to pay their debts, or as you said, defease their liabilities.
Right.
Now we've gone, I think quite a ways, the pendulum swing quite a ways the other direction. It seems like it's coming back a bit, but I think it would benefit the board to hear about where professionals think it ought to be and why.
Where the discount rate should be, so that
Well, and what the risk portfolio should really look like for a, but maybe that's more of a philosophical than a financial discussion.
It is a philosophical question, but because it all depends. It depends
And
on
I know
your-
Gene has comments.
And Gene could and should be sitting next to me, and it would be a great, robust conversation to talk about.
We should set up a point counterpoint.
We had done that once. We had done that at the board retreat a few years ago. We did a joint presentation. The assets and liabilities need to be mindful and work together. That's why we do an asset liability study. And we can't set an asset allocation in a vacuum, not aware of what your obligations are and what your cash flow characteristics are and what the current contribution environment is and the benefit payment environment is. We need to know all those things. And then what we do, I've used this expression with the committee before, we try to show you a lot of different lenses, like going to the eye doctor, and is this more clear, is this more clear, and keep making changes and tweaks, looking at different techniques, different analysis over different periods of time to gain comfort with what is right for your circumstances. So nationally, I forget what the average number, the average discount rate is. It used to be 8% for years. We think that is wholly unsuitable or not suitable over the next 10, 20, 30 years. And there's been an important trend to lower that to be more realistic based upon where we are in the economic environment in terms of go-forward stock and bond returns. You all have taken great strides in moving your discount rate to what we think is achievable based on what the capital markets will give you. And so the number that you're at right now, that 6.5%, strikes us as wholly appropriate given what we think is achievable in the stock bond market on a go-forward basis.
Thank you.
Being a little older than many people here, I've lived through a lot of cycles, but I can remember times when interest rates were up around double digit in the 12, 14% range, and the last 10 years of 1% interest rates is unprecedented in the history of the United States. So when you have 1% or 0% interest rates on the fixed side, it doesn't give you much return. You've got to shift to the equity side. The equity
Right.
side is what is really, and so that's why you go from the 60-40 to the whatever. But there is more risk. You take on more risk. So if you look at our portfolio, our risk is in the equity side of the portfolio.
The one thing we know is things that are unprecedented tend not to go on forever.
Well said.
Hopefully.
Other questions or comments?
Bill, it's your floor.
So given that, what I'd like to do is make a motion for the board to approve. Motion to approve staff and consultants' recommendation 1 and 3 on the asset allocation presentation and to change the infrastructure benchmark to CPI plus a percentage within a range of 4 to 5%. The chief investment officer will set the percentage within the range upon further discussion with the private equity advisors.
George is in the queue, but I don't know whether,
Well, do we want him to move it?
Well, after the vote.
okay.
I want Bill to move it.
Bill, as the acting chair, would you move that item?
Okay, I'm looking for it on my
Needs a button.
screen here.
Go George needs to move himself.
Oh, I see. George moved it.
George moved it. So
You want me to
George,
withdraw? You
Yeah.
can do it, Bill. Go ahead.
There, okay, now I can do it.
Ready to vote? All votes are in.
Okay, and we have yeses 10, no zeros, and so we pass the motion unanimously. And we will move, now do you want to move into the performance?
Well, I covered that. I covered what I had planned to cover in
Planned to
performance
cover,
at the
okay.
outset. So that
And that would be it.
that concludes my my remarks.
George is in the queue.
Yeah, I'd just like to comment that, again, thank you, Steve. We have a pretty large unfunded liability, and I think it's, all of our duty to see that we give the city the best performance that we can. And I'm wondering, after a more detailed discussion yesterday, if we're being too conservative, that you showed a chart where we're way under our risk budget. And whether that is directly applicable to my comment or not still remains to be discussed. But what I do note is that last year, which was a banner year for a lot of people, we were in the middle of the pack. We were in the 45th percentile. And since inception, we've been in the 10th percentile. We've been in the upper decile. So does that mean we were too conservative? And this is related to the other questions that I asked earlier. And so I want to work with you and the staff to give a better discussion at the next meeting.
Sure.
Do you want to express any thoughts on that today, or you want to wait?
I can express some thoughts. So the notion of conservatism relative to peers, your performance relative to your benchmark was exceptional. You added 90 basis points of value. Your performance relative to your peers last year, I didn't show that. That was something that the investment committee spent some time on yesterday, was about the middle of the pack, as George mentions, at the 45th percentile. And we talked about why that might be. And we don't exactly know precisely why that is. There's hundreds of different peers in our database when we calculate those returns. But we could make some good educated guesses based upon what we know about the data in that data set. And in part, you have more exposure to things like private equity and real estate. Your peers have more exposure in things like liquid stocks. And it was hard to beat a 25% U.S. stock market return last year. And so anything that was different than, say, the S&P 500 would have caused you to lag a little bit relative to your peers. When we look at, say, 3, 5, 10, and as George mentioned, going back 20 plus years, you're at the top of your peer universe. You've done exceptionally well relative to your peers. Last year was a little bit of a different scenario.
We
Great.
can move into the rest of it
So
later.
thank you very much, Steve. Really appreciate your presentation, and you're excused.
Thank you.
Can I actually ask?
Oh, wait a minute. You're not Tanasi?
I just had a quick question.
Tanasi
which is,
woke up.
If we're, well, I was in the queue, just some people aren't paying attention. My only question to you is that the fact that we had a lower upside, but we've had a lot lower downside, doesn't that sort of suggest that maybe our fund is a little better inoculated than our peers?
You're more diversified than your peers. So
You don't like my word of inoculation? That's fine, okay.
I'm not sure how to use it in an investment context, but
An inoculation assumes you can't get sick, and that's
Yeah.
probably not a good analogy.
you have some more downside protection relative to your peers.
And the last comment I just want to make is that while I appreciate the comparison to our peers, the fact of the matter is that there are some huge differences, not the least of which is philosophical differences from plan to plan. So can we really, truly go out and look at our peers and use that as a reliable benchmark for what we're doing?
Your comment's well taken. No, is my very short answer. But we want to be mindful of performance on a lot of different cuts. One, the most important thing is, do you have enough money to pay your obligations over time? What's your true absolute rate of return? And we showed you that, and it's been strong. Then the next cut is, how did we do relative to our benchmark? That's been good. Then the third cut is, how have we done on a risk-adjusted basis? Are we taking too much risk to achieve the returns that we have? That basis is great. And then last, fourth, and importantly, truly last, to the point that you're making, is how did other people do? And then we can ask ourselves, do we care about how other people are doing? But you're hitting, you have hit on all three of the important
How did
key
other people do
considerations.
and why?
Yeah, hard to know exactly.
Yeah.
Right. But
Thank you.
Yeah, thank you all.
Thanks.
Thank you, Steve.
So the next item on the agenda is the Audit Committee, and Bobby Spoon is going to report out.
We had a short meeting Wednesday. We had no action items. There were two things I wanted to mention. Lee Paravano concluded the audit of the retiree payroll and made some recommendations to management, which have all been incorporated. However, he commented on the strengths that he found that were already in place with the retiree payroll, those being cash reconciliation procedures, the IRIS automated general ledger entries, and messages that are alerted to staff through the system. So that audit is complete, and we're certainly satisfied that the retiree payroll is rolling along great, just great. The other thing I wanted to mention is that Lee Paravano has submitted his resignation. He's moving to the Airport Authority. We're very much going to miss him. He's done a stellar job. He was complimented by the Audit Committee, and we're sorry to see you go. We have started a search procedure to replace Lee, and your last day is April 3rd, is that right? So thank you. Thank you for your very good work these years. And that's it.
Tanasi.
So, Lee, quoting one of my favorite movies, out of complete frustration, "You're a lousy softball player."
Would anyone else like to roast Lee before he leaves?
I agree.
I'm sure that we will have an appropriate farewell for Lee at the appropriate time, but I'll just add my comment that it's been a pleasure to work with you, Lee, and you've made this system stronger, and you create the pattern or the mold that we are going to try and fill when we attempt to fill your shoes. And I would call you up to speak now.
Allow me to defend myself. I do play on a co-ed softball team, by the way. It's awesome. Over the last 4.5 years, this board has hired me to look into things that may not be pleasant. And we've had some discussions with management and with the board that, you hired me to look at things that may not be correct or that management may disagree with me. But I don't really get the opportunity to tell you the one thing that's truly going right, and that's management and the board. Your management and staff here is wonderful. I have loved working with them. It doesn't come out in my audit reports, but you have a fantastic staff. And I wish you all nothing but the best. Thank you.
Thank you, Lee. And it's great to hear that from an internal auditor whose point of view on everything is perfectly objective. All right. That brings us to business operations, and I'm going to call to the witness stand Gene Kalwarski, I think David Holland, and Alice Alsberg, the dynamic trio. We'd like a presentation, please, on the June 30, 2017 actuarial evaluation of the City, Port District, and Regional Airport Authority. And Steve, you're welcome to leave if you'd like.
I enjoyed this.
No, you don't need to stay
Unless
for
you
this.
want to hear me point counterpoint with Steve. Right. No, actually, there's just a couple of things. If you don't mind, I'd like to just comment on. I have presently been working with some of the, trying to assist some of the worst funded systems in the country, Detroit, Dallas, Illinois, some of the Taft-Hartley Fund central states. I've seen plans go insolvent, and the single biggest mistake those funds have made is to compare themselves to their peers on returns. What Tanasi said was exactly right. There's different philosophies, different maturity levels. Worst thing you can do is make your comparison to your peers be your goal. And I think Steve probably would agree with that, right, Steve?
Yes, I will.
And second, when you mentioned the return and you pick it out of the air, I would think that you really try to pick your risk, which is measured by your volatility, and what volatility can you afford. And once you find the highest level of volatility you can afford, then find the highest return. So that's all I have to say about the.
Well said. Thank you.
So we came here in January, and as typically is the case, we'll present the results in January, and then the board has 3 months to go over what we had done and then vote on it in March. That's what we're doing today. We're also going to just open the door to funding policy, and in particular amortization periods, but that's the details on that are going to be more relevant in the July presentation as opposed to today. So what you're going to see coming up is just a repeat with a few extra slides because some board members did ask for additional information, what we did in January, so we may do it in a bit of a briefer format. And I'll start with going over the city's historical trends. Again, this was shown in January, and this shows the bars are the liabilities of the system, and the lines are the assets, and you see two types of assets, a smooth value of assets and a market value of assets. And you'll see during market downturns or upturns, the smooth value of assets will lag and smooth out the returns and serve the system well. And the funded ratio, starting at 1995 and 92.7, is now 71.2. But most importantly, you'll see this coming up later. That's while the discount rate moved from 8% to 6.5%. So if we were to measure the discount rate at 8% today, you'd be very close to where you started. The next chart was annual gains and losses from investments and liabilities. And you can see the investment gains and losses fluctuate, and they're much larger. And Bill, you asked the question last time, could we add a column on what the returns were for the year? And so that's your column there at the far right, showing what the market value of return was for the year.
I noticed that column is in black. Was there a reason for that?
Bill asked for that.
Oh, I'm just saying, but the color.
But the assets are actually smooth over a period of approximately 4 years. And you could see that on the liability side, you're pretty close. You know, it's easier to predict when people are going to terminate and retire and die as opposed to what your returns are going to be for a given year. The next two slides are two different ways of showing the same thing. And again, this is in response to a question that Bill has raised over and over again. Why is our unfunded liability growing? And on this slide, we're showing why it's grown since 2007. And the gray bars, portion of the bar, are the 2007 liabilities. And if you're below the zero line, that's reducing the unfunded liability, so that's contributions and minor benefit changes. But the two key drivers of your unfunded liability increase are your assumption changes and the investments. So the 2008, if you look back, or 2009, where that green first appears, that, and go back one slide, that major hit there you see with that drop down to 2008 or 9, that resulted in that green appearing, and that combined with your assumption changes, both economic and demographic, really answer the whole question as to why your unfunded liability has grown. Another way to look at the same graph, and I don't know which one's easier for you, is just forget about year by year, just accumulate the whole thing. You can see $1.1 billion of your change in the unfunded liability. Well, the entire amount has changed $1.57 billion, but $1.1 billion is due to the assumption changes. And then another $750 million due to the investment loss. Everything else served to pretty much decrease your unfunded liability.
The purple or violet assumption changes, the demographic, is that specifically the experience study, or is it primarily the experience study?
Primarily experience study and primarily mortality.
And those assumptions, demographic assumptions, are those largely absorbed by our peer funds in their unfunded liability numbers or their funding ratios?
You said your peer funds?
Well, other funds, like the County of San Diego,
Yes.
LA County.
This mortality change is something that's hit
That's
nationwide.
widely adopted.
Yes.
Okay. But the black part, the economic assumptions, to the extent that other funds are lagging our fund in terms of lowering their discount rate to what we've just heard is a much more realistic number, the other funds don't have that black section.
They have it, but not quite as large.
Okay.
You've been to the forefront of lowering that discount rate, which I agree with
Actually, Val,
Steve's
you
comments
know,
on it.
we did, you did a study where we looked at the peers and the ones that were close to 100% funded, 90%, and they had not implemented the demographics into their numbers.
Some of them
So
had
that's
not. I
why
remember
you
we
were
had,
so high.
I think Marcel, did you
Yeah.
presented that? Yeah.
Gene, can you go back one slide? The blue line in 2016, the liabilities, what, 16 and 17, what is that? Because it's not on the other, oh, they're over the,
I think it's salary increases.
Salary experience.
okay. Thanks.
But it is in the blue.
I see it
It's in a
now.
positive in 10, 11, and 12. See it?
I see it.
Yep.
Now, I wouldn't expect you to, going forward, to have much further, if at all, to go with assumption and both demographic and economic. So,
Actually, Gene, can I just one comment when you go back, if you can go back one slide. The blue line, the liabilities from 2010, 11, 12, and 13, those are, I think, consistent with the salary freeze. Is that correct?
well, it's part of it.
That's where the assumption out.
There's also turnovers in there, retirements in there, disabilities in there. And, but part of it is the salary.
The reason I'm just asking the question, and it's really more of just a question, which is, it doesn't seem like the salary increases that get a lot of political discussion really move the needle at all
That's
on this fund.
absolutely true.
Okay, thank you.
Gene, I had one more question, sorry. If we were to reduce the amortization periods from where they are now down, would that show up in this chart as an assumption change, or
No.
it wouldn't, because
No.
it's just a contribution?
This is just to do the measurement of liability, not the contributions. But later in our presentation, we will show you. But I'll tell you up front, your gains and losses, even with the investments, only represent 1 to 2% of your total unfunded liability contribution. So whether you change it from 15 to 5 to 100, it's not going to move the needle. But we'll show that with the modeling.
I have a question. So this is a pretty distressing slide to me. Maybe you can comfort me. You know, we've had one heck of a bull market in the last 10 years, and our unfunded liability remained pretty constant, and then it's gone up. What's it going to be like when we don't have a bull market? And are we missing the opportunity to reduce this unfunded liability during the good times?
Go back to slide 4, Alice. I've been reading where people are saying we've been on a 9-year bull market run. The way the bull market is being measured is above 0. Well, you've got to earn your assumption. You look at that black column, you didn't have a bull market in the prior year, the year before that. You didn't have a bull market 5 years ago. So when you hear about this 9-year bull market, they're just referring to not having a negative return. But your assumption isn't 0. Your assumption was 7.
Half, 7%.
Yeah. And again, going to slide 6, $1.1 billion of that unfunded liability is because you became more conservative with your assumptions.
The only other alternative would be to float a pension bond or somehow go get money if you want to address this.
Yep.
Gene, I guess I also want to ask, we're seeing the bump when we did the experience study, but the reality is that bump has been a gradual slope for years. We just didn't necessarily capture it. I mean, people have been living longer. It didn't just all of a sudden happen that 2 years ago everybody started living longer. That's been a trend that we might not have been capturing 100%
Right,
of.
and so the Society of Actuaries did, for the first time in a long time, a major study to look at that and discover that this generational mortality improvement taking place, and it's hit pension funds nationwide.
And pension funds nationwide that haven't reduced their discount rate to a realistic number have a built-in bias
Yes.
showing greater funding than they actually have.
Yes. I think in Marcel's study, though, she was able to, are you not doing that today, Marcel, right? No. was able to put them all on an equal basis. Do you recall what San Diego would be if they were at 8? Or, well, you could probably answer it later. It's in that model.
It is. So I didn't do it at 8, but I did it at 7.5. And at 7.5, we'd be about 78% funded. So that was
Probably
a
over 80%
like a
funded at 8.
7-point improvement. So if we did it another 0.5%, we'd think probably another 7-8 points. We'd be over 80% funded.
So
Yeah, which shouldn't give us any comfort because those aren't real return numbers.
go back to slide 4, Alice. So looking at another way to answer the bull market question, look at those gold bars. The bull market we're referring to are the gold bars above 0, and there's some below 0 recently. And compare that to what happened in 2009. And clearly, those returns aren't going to offset that massive loss you had in 2009, which is true everywhere.
Did I hear you say that our problem is that we've been conservative?
No.
No.
No, I didn't say it's your problem. In fact, that's your positive.
But
Well, I'm wondering,
he's-
I'm wondering if one of the answers on how to fix this is to be less conservative.
I wouldn't.
Because the money's got to come from somewhere. Either the city's going to pay for it, which reflects on the taxpayers, or we got to fix it. And so how much conservatism can we afford before the city can't afford to take care of it?
I don't believe the 6.5.
That's my fundamental worry here.
You will have, in the corporate world, they're using discount rates of 3 to 4%.
Yes.
And I don't believe a 6.5% investment assumption is conservative. I believe it is conservative only when relative to other funds, but those funds are marching down.
I would think that based on what we just heard from Steve, a conservative discount rate would probably be like 6.
Or even below
or
that.
even below that.
Yeah.
Yeah.
Steve still here?
You know,
Right behind you. Looking right over your shoulder.
I still believe if we reduce the amortization schedules, we pay off the unfunded liabilities sooner. Now, the only question is, how much impact does it have on the city and their contributions? That's the only question. And so at some point.
So when we get through the valuation and accept this year's valuation, we will open the door to that discussion. And in July, we'll have a full session on that. So that concludes the historical review of just the city's situation in SDCERS. Alice is going to talk about the Unified Port District and the Airport Authority.
Great. So we'll go through the same historical models, the historical charts, but for the port and the airport. Looking at the Unified Port District, you see a similar picture from the city. At the beginning of the time period, they were over 100% funded. And then in the last 10 years, the funded ratio has hovered in the 70th percentile, with the same factors impacting that. So the downturn in the market, and then the steadily firming up of the assumptions. In terms of the gains and losses for the port, again, we see that the gold bars, so the investment returns, those always have the most significant impact. You see the fluctuation is definitely more prominent than on the liability experience. And on the liability side, the assumptions that we set in terms of the demographic and economic assumptions are a more reliable gauge of what's to come one year to the next. And the port did experience gains on both the liabilities and on the assets for 2017. Looking at the factors that built up to the UAL that the port has today, so their net UAL is at 140 million. We see the same key components that have brought it to where it is today. So the green bars, the investments, the losses have built that up. And then the black and the purple bars, the black being the economic assumptions, so ticking down that discount rate, and the purple demographic assumptions, the improved mortality led to the increase in the UAL. Here we see that the final column, the 2017 column for the port, and just seeing the numbers. So for the Port District, we see that the economic assumptions was really the main driver in this case for the increase in the UAL at $50 million. Now turning to the Airport Authority, we've seen this before and discussed it. Their picture is slightly different in terms of their funding ratio. So we see that the actuarial liability, the bars, have steadily increased as the plan matures and more liabilities are accrued by the members. But their assets have stayed closer to the top of the bar, meaning their funded ratio has been maintained at a higher rate, and that's due to the airport's internal funding policy. So they're making more contributions to maintain a target funding ratio.
Alice, can you opine as to how important that was for Lee leaving the city and going to the airport?
Very.
Looking at this, I don't think they even need an internal auditor.
He's going for the easy street. All right. In terms of gains and losses, you'll notice that the blue bars, the liability gains and losses, those do fluctuate more for the airport than you would see for the city or for the port. And that's largely because it's a smaller plan, smaller liability. So as a relative percent, the fluctuation is a little larger there. And the airport had gains both on the liability and on the assets in 2017. Given the airport's internal funding policy, what we see more here is that the net line fluctuates up and down so that UAL has bounced around over the period shown. And the same contributing factors, we have the investment return losses that have increased the UAL, the firming up of the economic and demographic assumptions. But the yellow region, you can actually see the portion here that the contributions have helped bring down the UAL over time. So putting those additional contributions in allows them to have more returns on those contributions and helps limit the unfunded. So they're at a $20 million unfunded right now. And then we see the same picture just for the last year, the 2017, where the economic and demographic assumptions had equal impact for the port's UAL, followed closely by the investments. And I'll turn it over to David for the results.
All right. No, just reminding you that these June 30th, 2017 valuation results, again, were presented in January, and what Dave is about to present is no different in terms of the valuation results than what you saw in January.
So before we get into the results, just talk about the member contributions. You're already aware that back in September, you lowered your discount rate to 6.75 this year, and then it'll be 6.5 next year. And then you had a 5-year layering approach for certain amortizations to improve the projected stability of your employer contributions going down the road. So as far as the impact on member rates, there's a substantially equal requirement, as you're aware, that requires anytime you change assumptions or you change benefits, that the member rates also change as well. So we've adjusted those rates effective 7/1/18 to reflect that change. And the average impact on the general members is an increase of 0.6% of pay. And for safety, the average increase is about 0.9% of pay. And those rates are no different from what was presented in January. For the port and the airport, they have cost sharing that's required for their PEPRA members, the people who entered on or after 1/1/13. So basically it requires that they pay half of the cost, and then once you set the rates, they remain the same unless your normal cost rate goes up or down by more than 1%. So the port safety plan and the airport general required an adjustment to those rates, mostly because of the assumption changes you've been making. Just like it's increased the employer's costs, it's also increasing the employees' costs now. We also needed rates for the new port miscellaneous plan, who they entered the plan, if they entered the plan 1/1/13, they have a 5-year tunnel, so they can start coming in 1/1/18. So we needed new rates for those members. After the January meeting, we were directed by staff to recalculate the PEPR rates that we had presented in January under a new interpretation of the cost of living annuity. Before, what was done is the member rates were set based on 50% of the whole, of everything together. So if the normal cost rate for a particular member was 20% of pay for all of their benefits, including the coal annuity, then the member rate would just be 10%. It would just be half of that. And now what's effectively being done is the expected cost of the coal annuity is being covered entirely by the member. And that results in an increase in the member rates. And so that change, that method change was we were told to do that by SDCERS by council and staff, and that would be effective with the rates starting 7/1/18.
David, it may be helpful if you explain to some of the board members that are newer especially what a coal annuity is.
It's probably best not to go into the history, but basically it's an additional benefit where whatever your member contributions are, say they're 10% of pay, the coal annuity contribution is 20% of that. It'll be 2% of pay, and you just pay that as you go through your career. And when you terminate or you become disabled or you retire, that accumulated amount, it's accumulated with interest, and that gets annuitized and turned into an additional benefit for the member. And so before, the idea is that the members are supposed to be paying the entire, the expected cost of that benefit. Before I get into the results, I'm going to really quickly turn to the appendix. The city member rates that we had presented in January, those have not changed at all. Those are in the valuation report. What I'm just showing here is for the port safety. These are under the previous method for previous methods, previous assumptions. Port safety under the new assumptions and the new methods. And the rates are for port safety, they average about 1.9% higher. And then for airport general, these are prior assumptions and methods, new assumptions and methods, and they're about 1.1% higher on average.
Now, Lee might not have left for the airport authority had he known this.
He is back there smiling.
And then finally, UPD miscellaneous, we have rates effective 1/1/18 based on the previous method for the coal annuity, and then effective 7/1/18 under the new method. So now I'll go back to this year's results. Like Gene said, the changes were minimal, so I'll go through pretty fast, but feel free to stop if there are any questions. So for the city, the unfunded liability has increased from $2.56 billion to about $2.76 billion. And the funded ratio has gone from 71.6% to 71.2% as of 6/30/17. And looking at the actuarially determined contribution, that declined slightly from 324 to 323. This slide shows the sources of change in those figures. Basically what happened is you had positive experience on assets that reduced the UAL and the ADC. You had a small increase from liability experience. Most of that was from salaries being a little bit greater than expected. You had the discount rate change, increasing your liabilities and contributions, but you also had that 5-year layering that smoothed out some of the contributions and reduced the ADC. So the net impact was that the UAL is about $200 million over what it was last year, but the ADC declined very slightly. And these results are identical for the city as what we showed in January.
Can we take a pause there? And I would ask you, David or Gene, to address that, because there would be people who would say, our UAL went up and we had a 13.5% return, and we didn't make any, what's going on? And I think it just deserves a little bit of discussion, because I know that we have a plan for the UAL to disappear over time, but maybe we could just quickly review it.
It's the biggest number there is that $254 $250 million increase in liabilities because of changing the assumptions. It would have gone down.
So we would have had an improvement in our unfunded liability, except that the board took the step of reducing the assumed rate of return out of conservatism.
Yes.
Right.
What's going to be the impact of the pay raises?
Go ahead, Gene.
I would question, you used the word conservatism.
Economic reduction of risk, a desire to reduce risk.
Inoculate the fund.
No inoculation. By conservative, I mean to reduce the need to chase returns by making risky investments.
Yes.
For the Port District, their unfunded liability increased from 129 to 138. and the funded ratio was pretty much stayed the same, at 74.3% this year. The ADC increased from 17.7 million to 17.9 million. And the sources of change are mostly the same. You also had that amortization method change for the port and the reduction of the discount rate, but you did have a small gain from liability experience. So overall, again, both the UAL and the ADC increased slightly from last year. And finally, the airport authority's unfunded liability is 19.8 million this year, with a funded ratio of 89.2%, and the ADC is 5.7 million. And these numbers for the airport and for the port are slightly different from what was presented in January. The ADC is a little bit lower. We're talking a few tens of thousands, because when we increase the member rates based on that method change, pushes the employer's cost down somewhat. And then finally, the sources of change are very similar for the airport, with gains on assets and liabilities. They actually had a gain, mostly from salaries. The one difference with the airport is that they didn't have that method change with the smoothing, because they didn't have that projected drop-off occurring down the road.
Okay, this might be a good point to have the board vote on the valuation results, because going forward, a look ahead is going to be based on amortization periods and the like, stress testing.
All right. So if the motion button comes up, I'll make the motion, and then we can open it for discussion if the board would like to have a discussion.
Looks like Karina's in the queue.
My
Karina?
question's been answered in the interim.
All right, and I think Bill is in the queue.
Could we go back to slide 13?
You're giving Steve's presentation?
Sorry.
Are we voting on who does it better?
Okay, so I'm going to make this point one more time. The airport authority has a higher funded ratio. And the reason they have it is they have their board, the plan board, has made the decision to contribute more to keep the unfunded liability at a lower level. Okay? That was a conscious decision that the plan board.
Well, the
All right,
airport
now-
authority made that decision, not
The
us.
Airport authority,
Right.
right. So our plan board is the city.
City council.
City council, and they do not want to do that. But one way we can do it is by changing the amortization rates, which forces a higher contribution and forces it to get paid off sooner than later. But what it does is it brings down the unfunded liability sooner. So that's the only point I want to make. Here we have within our own group of plans, somebody who has done it, and it's been effective. It works, we can see it. They have a much higher funded ratio than we do.
Right.
And we will be elaborating on your point when we do get to the modeling part. In fact, we'll start off with that.
It is a way of submitting a larger annual bill to the city and paying down that unfunded liability. But the city presently pays a substantial amount of its budget toward the unfunded liability, and there are multiple factors at play, and I think we're going to have a full discussion of that in July, if I'm not mistaken. All right.
Was there a motion on the?
There's a motion, and I don't see anyone in the queue. Does anyone want to have anything further to say on this? All right, then the motion's been made. Do we need a second? We have a second.
Ready to vote. All votes are in.
All right. So the actuarial valuations have been approved unanimously. And Gene, would you like to continue now with looking ahead?
We're going to start showing you some stress testing, but before I do that, you may be hearing or reading about certain developments that I've actually seen recently. There's a group called the Pew Foundation. You're familiar? And they're going all over the country to state legislatures, and they're dealing with the statewide plans, and indicating that pension funds must do stress testing, require them. In fact, New Jersey's, Chris Christie's last act in office was to require New Jersey to do stress testing. And they're writing about it and presenting about it as though no pension funds are doing stress testing.
You mean he didn't close down roads or anything on his way out?
No.
Okay.
It's probably the one good thing he did. And I saw at NASRA, National Association of State Retirement Administrators, Keith Brainerd, who's their research director, have a presentation saying funds must do stress testing. When you read about this, it's going to sound like no pension fund has ever done stress testing. Well, you've been doing it since at least day one that we've been here, and that's what this is. So I'll go through what we're looking at here because I know it's complicated, but some of you have seen this and it's not as complicated because you've seen it for a long time. The top chart is showing your liabilities. The bars are the liabilities and the line are the assets. And the difference between the lines and the top of the bar are the unfunded liabilities. Down below are the city contributions in the gold, yellow bars and the member contributions in the green. And there's a baseline there, so as we play with changes, you can always compare what the change is going to be to what the baseline is. So let me get right to Bill's point. There's a lever up in the upper right there, and it's their amortization basis. It talks, actually, let me just finish explaining the chart again. On the left-hand side of the chart are the returns. Then we could also model liability gains and losses, because that was asked for in the last meeting, then the ADC, the city contribution, and then the UAL. And we could play with different returns, historical returns on the top. We could change the discount rate. We could look at how the police negotiations, how that's funded. But the far right is what I want to focus on, because that's what Bill is asking about. Let's reset all the amortization, all the bases, not to 5 years, and get rid of our unfunded. So that will get rid of your unfunded in a little more than 5 years because you're smoothing in some losses. But what's the size of the gold bar? If you can hover over it, Alice, it'll.
Yeah, but that's recent. Is that retroactively?
Yes.
So that's an extreme move.
Yeah, I'm trying to show.
We're going to show the whole spectrum, I presume.
And in July, we'll play with more, but I just wanted to show the two extremes.
Right.
Yep.
Yeah, if we pass this, we'd have riots in the streets.
But darn it, we get funded.
Yeah.
Right, I'd have to come here in an armored vehicle.
Don't you already? No, okay.
So can you go to the PowerPoint that has those useful slides that are, I don't know, Greg, did those get printed, those extra slides?
Marcel is providing a copy to the board, and for the public, there's a couple in the back folders.
Thank you. So this is changing the UAL payment for gains and losses to 5 years, retro and forward. What I showed in the model before was not just gains and losses, but the assumption changes from 30 to 5 and everything. So this is just gains and losses. And thank you very much. So you don't see a big difference between 5 years, which is the green line, and the red, which is 10-year, and then the current amortization periods. And what's the next slide? I'm trying to remember. And this is future, go ahead, future gains and losses.
Yeah, these slides, this slide and then the next three are showing future gains and losses, five-year amortization, 10 years, 15 years, under different return scenarios.
So the most important chart might be the next two. If you go to 5-year amortization, you will fund things faster, but you see the extreme volatility versus 10 and 15. And if you, the next slide is the negative returns and then positive returns. So the reason most pension funds are using periods like 15 or even longer is to try to dampen the volatility in the contributions, because volatile contributions and spikes in contributions tend to end up creating bad news for pension funds.
But it also makes it more difficult for the plan sponsor to predict their expenses, and therefore their inability to predict expenses makes the ability to fund us long-term kind of at risk.
Right.
I mean,
you're absolutely right. Can you go back to the model, Alice?
I'm confused about your assumptions here on the returns for these two, because the previous slides all showed 6.5% for every year. And now, is this some...
We're just showing a period in history that starts out with bad returns and positive, and another period that ends up with, Alice, go back to 3. So this is starting out with positive returns, ending with negatives, and then we're just randomly picking different periods in history. We can go through all the periods in history, just trying to make the point that the shorter your amortization period, the more volatile your funding, which isn't necessarily a bad thing, but it just wants to make that point.
So are you saying these returns are overlaying returns, say, 20 years ago, and that history, you've just repeated it here? I'm not
Yes.
following it. Is that what you're doing? So what was the period that this represents?
So this one, for example, is from 1988.
88 going forward for 15 years?
30,
Well, 15 in this chart.
15 in the chart, yeah.
So,
Yeah,
so this helps us to sort of bracket what the city contribution would be under different assumed hypotheses of returns with the shorter amortization periods.
Right.
So we can see that it will range from, a much lower number than 300 million to a number in the $500 million
And
range.
remember, this is supposed to be discussed in detail in July, and so what we intend to do is to put together a booklet that has a whole series of slides like this, not just limited to these few slides.
Okay.
This is just to
great,
introduce the topic.
because it really gives us kind of a framework.
Yes.
And that's nice. And what's interesting is, if you go back to one of, any of them, what we see is the 5-year really is an extreme. To take everything to 5 years or to retro it or all that, that's an extreme, and I totally agree with that. Maybe somewhere in the 10 to 15 year they're pretty close, and it doesn't really increase the payment that much. I mean, you could, I think the highest one I saw was around 400 million, but we're currently at what, next year, July 1st, it'll be 350 or something. So it's not that big a change to reduce it from a 30 and a 20 maybe down to a 15 and a 10.
Yes. And
That's what I'm seeing.
and that's
It's not that big a change relative to what the payment is, but we don't exactly understand the impact of that on the sponsor, and what politically that might mean for the fund. We probably need to explore that a little bit.
Reduce the unfunded liability. We all agree
Absolutely.
with that.
It would do that.
And if it's not that big a change to the sponsor, I mean, yes, maybe a $25, $50 million change, that's pretty substantial.
Right.
But they've been going from 260 to 350 as it is, just with the mortality change and the other. So I don't know.
There's another chart that, I was stuck in airports for 12 hours yesterday, so I had nothing else to do. But I didn't get it to Greg on time, and it'll be part of your package. The city's currently paying $255 million in UAL payments. Of that amount, 140 million, more than half, has to do with, back in 2012, we took all the non-police, all the amortization bases, assumption changes, method, everything, rolled them all into one and amortized it over 15 years level dollar. That's key, level dollar, as opposed to level percent of pay, which starts low and ends high. So I don't think anybody's considering changing that. Your UAL in 2007, that's the green part, 36 million, that's already being amortized over 10 years. So we're not really thinking about changing that. This more has to do with the retro. All your experience losses, assets and liabilities, there's positives and negatives. They only amount to $3 million out of the 255. So we could change that to 5 to 100. It's not going to change anything retroactive. One of the key things is the $82 million method and assumption changes, and that average amortization period is close to 26 or so. But recall, I had said that I had recommended the 30-year because I knew we wanted to track down on the discount rate. I don't know if we would have gotten down to 6.5 had we not had that, but that might be played with at the next meeting. But I hear, Bill, your bigger interest is prospective as opposed to retro, it sounds like.
I don't know. I think looking at this, it's interesting.
Well, the average of all of them collapsed together is around 15.
Right.
Another way, maybe, Gene, to look at this is under the table, the stochastic chart that you used earlier. We would reach a fully funded status, it looked like, in the year 2046 under current assumptions. If we wanted to reach a fully funded status faster, we could pick a year and say 10 years earlier, 2036. You could model that.
Yes.
And go back to that and show us what that means. I mean, this particular one that you've got up there has us getting fully funded in, it looks like 2033, 2034,
No,
or
no,
2023, 2024.
So change, Alice, that thing to 10 years.
I mean, if we set a goal to be fully funded by X year, we could see
So
how would we
there's an
accomplish it.
example, 10 years, and you get fully funded by, what is that, 2029?
2029,
What about
2030.
15? What's 15 look like?
15 is going to be close to your base. It's what you
Pretty
currently
close to
have.
where we are.
I have a question, if I may. I'm wondering if this is the right approach to the problem, analyzing 10, 15, 5, and 30. One of the principles in banking is to, match assets and liabilities. What would be the number on years that would match our cash flow incoming assumptions versus the obligations on the outflow?
You mean match
It's
your benefit
probably not.
payments?
It's probably not 10 or 15. Maybe it's 13.2 years. And so rather than analyzing each of these different scenarios, is there a different way to approach this problem and come up with a recommendation which is X years gives us a match of the inflows and outflows?
It's going to be somewhere, like you said, in between 10 and 15, but we haven't calculated that. You're talking about duration matching, I think.
Yes,
Yep.
yes. Why wouldn't you do that exercise so that we'd have that information?
Well, because July is when we're presenting it. And-
Okay.
and today was to intro it.
And I thought it'd be interesting to look at 10 and 15 years, because I think we're going to be in that neighborhood if we're trying to do that. And it seems like a reasonable thing if the board wanted to discuss it in terms of what's our goal for getting to fully funded.
But remember the lengthy discussion we had, probably one of the most lengthy discussions we've ever had, at least with our presentations, was that.
Smooth that cliff. I hear you.
You said it, I didn't say it.
I understand, but you and I disagreed about that at the time, as I recall.
So what was the, in the pie chart you showed, the 81 million?
That's all the
method
mortality, the
Method
discount
and
rate changes.
assumption. So that's currently at about 26 years,
Yep.
is that what you said? So if we were just to move that one down to 15, that may really help
Yeah,
out.
yeah. Because I would leave the gold alone, because that was something you, Alice, go back to the model. I don't think we have that today. You see that gray thing up on top? That cell there?
Yeah.
It's gray because we haven't programmed it yet, because we've been all the way up until yesterday talking about changes. We'll have that ready in July. That would take the prior assumption changes and shorten the period.
You would be able to do that,
Yep.
yeah.
So you could break that out.
Yes.
That might be useful.
Now,
Yeah.
that would be very interesting. Maybe that's a good chart.
So,
That
so we'll
kinda
have
gave me
that
a-
as well as the duration matching
Yeah.
concept.
Gene, would you address one thing, which is would you, we've had this debate before, and it's gone on and on and on about the impact of having a sudden change like the one we see in the bottom graph there. And a lot of our policy setting has been based on trying to smooth that out, and it was a very close vote the last time we did that a year ago. I think we were one vote apart. I think that's probably worth a very short revisit as to what you see as the downside of doing it that way.
In all the years that I've advised pension funds, I've always felt that you can't ignore the predictability, the budgetability of the contributions on the employer, because if you start ignoring that, bad things happen. In fact, here, a bad thing did happen. This plan is closed to new hires. And so I've always strived to develop contributions that are predictable and stable. And that's why I was a proponent of the layering. I don't think it weakened the system at all, and it just provided more stability.
So I understand the concept of year over year not having variability. That's great, but this isn't necessarily less predictable or unpredictable, is it? I mean, we're predicting it. in terms of what the UAL contribution would be.
Well-
It's predictably going to drop off by more than 2/3 in that year.
That's in the gold bars you're looking at?
Yeah.
Yeah, and that's a precipitous drop, and so it wasn't just predictability, it was stability.
Okay.
And so the stability part was the glide path down.
I mean, I can see a political concern that where you create a $300 or $250 million reduction in the city's budget in 1 year, there are going to be a lot of people with ideas about what to do with it. But that's over on the political side. That's not our.
No, but the political side affects your participants. They close the system to new hires. And so I think you can't put blinders on and ignore the political side. That's,
Gene, if I understand what you're saying is had we not taken certain approaches or had the city not taken certain approaches and had contributions been level or less volatile, let's put it that way, that there wouldn't have been the urgency or the need, perceived or otherwise, to do things like closing the plan. And so I think what I hear you saying, and it kind of goes back to the discussion we've been having, does it really matter how we calculate it? The board's really making a policy decision about how stable we want to make the funding of this plan. Because the reality is whether we amortize over 10 years or 15 years or 20 years, I mean, at some point in time, all we're really doing is playing with the volatility of the contributions. So at the end of the day, all we're doing, no matter how we get to it, whether we do it George's way or whoever, it doesn't make any difference. At the end of the day, all we're doing is making a policy decision about how much volatility we're willing to bake into the employer's contribution. And what you're saying is the less volatility, however that is probably better overall for the plan and our participants. Am I way off on that?
yes, no, you're not way off, but I want to emphasize that the biggest factor affecting volatility was Steve's presentation.
Well, but Steve's always been a problem, and we've known that for a long time now, so.
No, but the asset allocation, I mean, I think he mentioned it a few times. And so given what the asset allocation is, then we try to minimize
So
volatility.
what you're really just simply saying is it's still all part of that same policy coin. How much risk do we want to take within the plan? And that in turns affects how much risk the city is exposed to. But then the piece that we're talking about right now is, given that we already have that risk, how much additional risk do we want to put onto that plan sponsor in terms of the predictability of the payments?
Yes.
And so the point is, if we were just doing simply bonds, right, if that's all we were doing, then there's zero risk on the one side, essentially. I'm not saying zero, but close to zero. And so then we might be willing to take more volatility risk with the plan sponsor on this piece of it, because there's no risk over there. When you're nesting these risks, all we're doing is it's just a total overall exposure.
Yes.
Okay.
I think,
But this
you know, I just, in response to that, I think we have two hats here. So you're talking about the plan sponsor hat. That's one hat. That's not our job.
I agree.
You're talking about the pension board hat. Our job is to make sure that the money's there out at the end to pay everybody off. But we have a large unfunded liability, and we are at the peak of the market, and the market's been going up, and our assets have been going up, and our unfunded liability has too, for many reasons. But if you were to take that experience portion that's 26 years out and move it to 15, you know, we would reduce that unfunded liability sooner. We are going to have a higher unfunded liability coming at us here as soon as this market turns. And we are at a great market position right now, and the city is too. But then when you go into the next recession, the city isn't going to have the revenues, and we're not going to. We're going to have lower assets, and that ratio is going to go up. So,
All right, can I weigh in for just a second, because the chart's changed on me. I would like to go back to the last slide, if I'm not.
What just changed is we put in the 15 point, what was it, Steve, 15.2?
The return earned last year?
Yeah.
That's about right, yeah.
Yeah.
So that's the impact of the 15.2, that the gold bars have gone down versus the baseline and having the 6.5%.
Sure. I mean, all of this is going to, I don't want to address the volatility issue so much as I'd like to go back to the chart the way we had it just a second ago and
reset.
make a point. Reset.
Do you want the 15.2% return in there?
I want the chart that we had.
Yeah,
Yeah. All right. Is that the 15.2% return?
We'll put the 15.2 in now, Alice. No, that's saying you earned 675, but we know it's
Right.
15 too.
But let's leave it at 675 for just a second, because when I look at this chart, what it's telling me is, gee, if this board says, you know what, city, you've had a great time on the backs of the pension fund, you're using their money, you didn't pay your contributions, we gave you a long time to pay it back, you've enjoyed the money, but we want you to pay it back sooner. So what we're going to do is, all we're really doing is saying between 2029 and 2034, continue to pay about $400 million a year, which is what you've been paying for the last 10 years. Just keep that up for 5 more years and get this thing paid off. And so your payments going forward after 2034 are going to be much lower. And all we're really doing is saying, you owe a lot of money, you've owed it for a long time, pay it off sooner, and your payment's going to go way down. I'm having trouble understanding why that is to me, that's not volatility. There may be a volatility factor, but that's what you're talking about when you change the returns and all that, and I understand that. But just this part, I'm having a hard time understanding why it isn't fair to say to the city, pay it back, keep paying $400 million a year until you get this thing retired. You can afford it, you've been doing it, and I'd like to see it retired earlier.
You're revisiting the slope down that we had last
Yes,
time, right?
I have failed to understand from the beginning, Gene, why it is a political risk to say, pay off your debt, and then you can keep more of your money after that, once you're done paying your debt.
I would like to make a comment on that, because I think this is what it boils down to. And I'll use a simple example, and I want to back up and explain it. If you take out a 30-year mortgage, and 10 years into it, the bank says, you know what, we'd like you to pay that off in 15 or 20 years. How fair is that?
How fair is it when you steal the house?
Wait. Now, understand something else. If we were starting a new pension fund today, anybody sitting here would never let the plan sponsor get into the position that the plan sponsor is here. Okay, I think there is no doubt about it. The lessons we have learned, if we were starting the plan today, there is no way on God's green earth the city would even come close to being able to do what it did in this plan, because all of us know better. Okay, we all now know better. There's a difference between that and being here now. It's the difference between saying, oh, that person is, I'm going to prevent that person from doing drugs, versus, well, now they're doing drugs, what am I doing about it? Okay? The issue is, it's how do you keep that stuff? So there is an element of unfairness. I'm not opposed to it. I don't have a problem with the cliff. Okay, I really don't. Okay, what I have a bigger problem with is when we are going to add 20 or 50 or 60 million dollars to the fund just because we're going to pay it off in 15 years instead of 17 and a half, or 13 years instead of whatever. Because quite frankly, all the assumptions I've heard so far is, well, the city's been paying it, they can afford it. Well, just because they've been paying it doesn't mean they can afford it. Okay, and it's not my job to be the city. My job is to make sure that our pensioners don't take a reduction in benefit, lose their pensions, that doesn't change, and that we fund their obligation. I don't think the city's going anywhere tomorrow, okay? And as long as we make sure they reasonably fund it, okay, based on where we are. Again, we're in a corrective action. We're not starting anew. It would be great if we could start. It would be great if we could rewind the clock and say, don't do that. You shouldn't do that. But we can't. We're here today. What's the most reasonable path to guarantee funding, predictability, and sustaining the plan?
And I think there's a legitimate argument to be made that it's to spread it out and make it smooth. And I think there's an equally legitimate argument to be made, get it paid in as quickly as you can, as long as the plan sponsor can afford to do it, and it's not going to be a shock to their system.
There's another argument no one's raised yet. It's called intergenerational equity. So making it all paid up front 15 years is charging the current taxpayers for the sins of 2005 and earlier that's now in the retired population. We'll charge them, but taxpayers starting out in the 2030 era get the big break. So all it's doing is intergenerational equity.
No, they're not getting a big break, because if you look at the bottom line, if you take that money where the gold between the top of the gold bar and the red line out past 2034, that's intergenerational transfer of debt to people way out in the future, even further away from the events.
So are the first 15. I'm not saying you're wrong. I'm just giving you the arguments the other side uses.
Yeah, but I think intergenerational equity arguments are a bit of a slippery slope when it's going to be intergenerationally inequitable, regardless of how you do it.
But it's how inequitable per generation? That's the question.
I think there are policy considerations that outweigh that. And I don't see it as particularly fair to argue that we should push this out on our grandchildren instead of taking care of it now.
If I may, I'd just offer, as a city employee at this point, the mayor's office has put out to all departments for a 2% budget reduction with the payment being what it is now. So with the smoothing and stuff that we did, we offered up and we freed up some monies to decrease those potential reductions in city services as well. So maybe if they do continue to pay high like you're asking, more services are reduced and overall budgets are decreased.
But bear in mind, Mike, that what we're talking about is the year 2029, and what this chart shows, and I grant that you can show different assumptions with different charts, but in this particular chart, which is the only one I'm making a point about, because I'm not addressing volatility right now, you would have relatively flat payments. And what you'd be doing is saying, we're not going to reduce your payments by $50 or $100 million a year for the next 5 years, and that way you're going to be paid off after 5 years. So I'm not sure that a current budgetary issue like that would influence me very much in thinking about what's the best thing for the fund in 2029 or 2030. But I appreciate the point, and it's a good one. Boy, July's going to be fun.
Greg, I'm out of town in July.
Me too.
Gene, were
That's all
you
we have.
finished? I think this is a marvelous time to take a short break.
And happy St. Pat.
Meeting?
Yeah, right.
All right. We have finished with business operations, and we will resume the meeting with the Disability Committee. And Mike McBride will sit in as the chair of that committee.
Thank you. Yes, I had the pleasure of being the chair for this meeting, where we had Mr. Hoy, Mr. Perovelos, and myself. Item A that we discussed was the approval of the disability consent agenda, and there were 3 disability application items, and the committee adopted staff's recommendation for each of the following items unanimously. Staff's recommendation to approve the non-industrial disability retirement application of Booker Bowen. Second was staff's recommendation to deny the industrial disability retirement application of Mr. Christopher Moore. Third was the staff's recommendation to approve the industrial disability retirement application of Ms. Tasha Shields. Would any trustee like to pull an item from the consent agenda or comment before we vote? Seeing none, I move that these 3 items, I move these 3 items for a vote, which does not require a second.
Great. Let's push the button and we'll vote.
I have no.
We need a motion
There
button.
we go.
There it is.
Ready to vote? All votes are in.
And that passes 10-0.
Great. Thank you very much, Mike. Next, we
I have one more item.
Oh, okay.
If I may.
Sorry.
Just to inform the board of a discussion item that we had, which was investigating disabled retirees and the reexamination process. Mr. Tran explained to us the investigation and reexamination process for disabled retirees that are not yet age eligible to retire from service. The committee had a good 30-minute discussion, which again was rare for our meeting. It's generally a fast meeting, and felt comfortable that the current process appropriately challenges disability retirement determinations that may have changed over time while keeping a focus on treating our members with dignity and respect. Nuts and bolts of that was just the process to reopen someone's case and deny them the disability pension. And that process, which took into account public comment regarding the kind of the possible emotional trauma and other issues that arise out of that. And again, we came to the conclusion that the process that's in place is appropriate. And then last was the disability status report that Ms. Kloss provided for us. And that concludes our agenda.
Thank you very much. So Tanasi has already winked the Business and Governance Committee report, and so we move next to, no.
Don't worry, it'll be a wink and a nod. It's okay. All right, so really quick, the action items that we dealt with, items 1 through 4, really broke down into 2 parts. The first one was just the presentation of the budget, and basically the issues there were labor and legal were the 2 problems. So stay away from L&L in your budgets, and you'll be fine. Everything else was really changes that staff had come up with based on a 3-year, based on the mandatory 3-year review of the policies and procedures. They all passed unanimously. Unless there's somebody who wants to pull one of them from the consent agenda, I'll move to have those approved. Hearing none, let's
Ready to vote? All votes are in.
all right, and that passes 10-0. The semi-annual travel report was provided, and then we went through the status reports by division. I guess there really wasn't anything of particular note other than Cynthia claims that she didn't make her goal of answering calls within 20 seconds in December, breaking a streak, and after a very lengthy discussion, we determined that was simply a miscalculation error by IT. The 21-second time frame was actually not accurate. It was 20. So your streak is still alive and good. And apparently the culprit behind that in the first place was sending out too much communication to our members in 1 month. And so we've also agreed we're just simply going to stop communicating with our members so we don't have to bear the burden of their phone calls. I think I've summarized that correctly. Okay, good. Unless there's unless there's anybody who wants to pull, who would like to hear from or have questions of any of the staff members, or unless there's a staff member who has something they want to add to their report, that's really it.
I think just to interpret, Tanasi, for anybody who didn't follow, the call wait time increased from 20 seconds to 21 seconds
Only in the month of December.
for the month of December. And 12 seconds in February, and we're working to get it even lower.
When you average it out, you weren't even close in December. You're all good. All right.
Great.
Thank you. And I think I'm under my 4 minutes, so.
All right.
Yeah.
So that brings us to the balance of the investment committee report, and Bill Hayner chaired that meeting yesterday.
Okay, we have one other action item, and that is staff recommended changes to the SDCERS proxy voting policy and guidelines. Staff annually reviews SDCERS proxy policy and guidelines. There were no recommended changes to the guidelines from last year. This version was reapproved by the investment committee yesterday, 3-0. So I would make a motion, there we go, to approve that.
Ready to vote? All votes are in.
And that motion passes 10-0. We have two other items not requiring action. One is old business, update on the Deutsche Asset Management Real Estate Separate Account transition, and Jamie will give us that update.
Great, thank you. There were no significant changes since the January board meeting. The only thing that has come forward is that one of the assets has been approved to be brought forward to the market, and that should be occurring within the next week or so. The other two assets that we were evaluating for sale in fiscal year 2018 will likely be brought to market in early fiscal year 2019, so probably around July or so. The remaining 4 assets are being evaluated and monitored, and we're expecting to sell those over the next 3 years. And with that, I'd be happy to answer any questions that you have. Thank you.
Okay, thank you, Jamie. And then the final item is the investment division staff report. And I believe Anders will give that.
Good morning, everyone. The reconciled market value for January 31st was 8.3 billion, and since the last board meeting, 7 wires totaling 12.3 million were sent out to pay for payroll payments and operating expenses, and 2 wires totaling 78 million were sent out to pay for member benefits. Since the last meeting, we had a rebalancing action on January 10th, where we pulled 40 million from the public equity asset classes and transferred that to cash for future capital calls and member benefit payments. That cash was overlaid to real estate because we have a fairly significant underweight in real estate temporarily until all the capital calls can be funded. We're still in the middle of the RFP for custodial banks, so we're still in a quiet period. Staff will go to do on-site visits to the custodial bank finalists week of March 19th, and we expect to bring forth a candidate to the May meeting. Any questions?
Thank you, Anders. And that concludes the investment committee.
Thank you, Bill. That brings us to training, and I would call Johnny Tran.
Thank you. We have one request by Karina Coleman to attend the Pension Bridge Annual Conference in April. Other than that, I have not received any other requests, but we will need a vote on that one.
Oh.
Yes, Bill?
I had one for the PIMCO finally came up with a date, and I'd like to request attending the May PIMCO. I think it's May.
Have we already approved you for that conference? Maybe not a specific date, but the conference itself?
I don't know what the status is, but
Just to be safe, let's do it again. Thank you. And so that will be Bill Hayner for the PIMCO conference in May.
Where's that one?
Irvine.
Their headquarters?
Yeah. George went last year, and it was pretty good.
It's a great conference. If you haven't been to it, I've been to 5 conferences now. It's the best one by far.
What was the date of that one again, Bill?
I think
May.
it's May, but I'm not
Is that the
certain.
client conference?
Do we have another meeting prior to that conference so that we, if anybody wants that, maybe we circulate that information?
Bill, I'm sorry, what was the date?
I
It's
thought
in
it
May.
was in May, but I haven't got it with me here.
I don't have the finalized date,
Yeah.
but Val, for your consideration, we have done improvements retroactively and haven't had a problem,
Okay.
especially given it's in Irvine.
So then, Johnny, when you have the information on that, will you circulate it to the board so if other board members want to attend, they can do that, and then we will have to ratify if we.
Thank you. Jamie?
I just looked up the date that I have. I have the date as being June 12 through 14.
Yeah, I think.
And then there's
maybe.
another one in October.
Okay,
Okay.
that's right. Yeah.
Great.
Thank you, Jamie. Did you want to be added now to that, Val?
Not at this point. I need to check my calendar, but I will let you know.
Thank you. I'll need a first and a second, please.
Yeah, the PIMCO is very equivalent to like the Wharton Investment Conference.
And a lot less expensive, I take it.
Yeah. Right.
Ready to vote?
And that was one of the issues. The Wharton Conference, I think, is going to go on the too expensive list. And we need, because there are similar conferences that are done at Berkeley. There's the PIMCO conference. There's lots of other alternatives to that, just for trustees' future reference.
Ready to vote? All votes are in.
All right, so that carries 10-0. And that brings us to questions and comments from trustees, president, and staff. I know there are a couple people who would like to comment. I would like to first officially welcome Greg Rademacher to our board meeting and invite Greg to make any comments that he'd like to make. And then following that, I think Tom Sullivan wants to speak. And if anybody else wants to speak, just, I have somebody in the queue. We'll go to Almas, and then we'll go to Tom.
Well, thank you very much for the opportunity to join this team and be part of SDCERS in the San Diego community. The first 30 days have been tremendous. I've had the opportunity to meet with a lot of the board members and understand their perspectives, and I've really been embraced by the leadership staff and all of SDCERS staff. So we're off to a very good start. Enjoyed learning the SDCERS way and actually also giving some ideas for how we can do things a little bit different, a little bit more efficiently in supporting the board. So really excited to be here, and just thank you so much, and just looking forward to many, many years to come. I would like to say one thing is I wanted to recognize Marcel Rossman and her expanded leadership role here at SDCERS. She's now serving as our Deputy Chief Executive Officer. So I'm real excited to have her expand her leadership role here on the team. She's going to continue to oversee the leadership areas of our benefit admin and member services, but at this point we're also folding in the finance area. So we're real excited about that, and I'm sure her roles and how she helps SDCERS leadership team will expand in the future as we grow together. I also just wanted to briefly mention the departure of Lee Paravano. I know Bobby had mentioned that a little bit today, but I have the utmost respect for Lee, and I'm really disappointed that he's leaving our team. That was the only downside of my first 30 days when Lee said, "Greg, I have something to talk to you about." Tried to get him to stay, but I think he's really got a great career opportunity over at the airport, and I'm very pleased that somebody with the in-depth knowledge of SDCERS is going to one of our plan sponsors and can actually bring that perspective and the good things that we do here to the inside of that organization. So I also appreciate that Lee will have to address his own audit findings, which is very nice. And with that, thank you.
Great. Thank you very much. And Marcel, on behalf of the board, I want to add our congratulations. The board has the utmost confidence in you and is really pleased that you have this new responsibility and level within the organization. All right, so Almas.
I just wanted to briefly share that I had the opportunity to attend the CalPERS General Assembly earlier this week, where I met a number of investment types and I learned about a new title called Relationship Manager. It's one I might pursue one day. It sounds like a really cool title. But also wanted to compliment Marcel. She represented SDCERS very well on a panel talking about setting up retirees for success. It was an early morning panel. I can't promise that I was there for the first few minutes, but I definitely enjoyed it, and she was able to interject humor in what sometimes is a humorless subject matter. So well done. And also thank Cynthia for all the help with travel arrangements. I'm kind of annoying in my emails and questions, so I really appreciate the assistance.
No problem. Everybody here owes a big debt to Cynthia, by the way, that we just never say it. All right. Any other questions or comments? Then let's move to Tom.
I'd like to request that the Board of Administration adjourn the March 9th, 2018 board meeting in memory of Dave Crow. Dave was a valued member of our community. After serving his country overseas in the Army, he served locally as the National City Postman and for 33 years in the San Diego Police Department, retiring in September 1989 with the rank of captain. In retirement, he continued to serve in a variety of meaningful ways, including being an honorary mayor of Pacific Beach, president of the San Diego Retired Fire and Police Association, and chair of the Retiree Issues Task Force. Dave is survived by his wife, Billy, 46 years, a renowned city police dispatcher with 36 years of public service, 2 daughters, 3 grandchildren, and 3 great-grandchildren. Dave Crow will always hold a special place in SDCERS, having served as the elected retiree representative on the SDCERS board from January 1999 through June of 2004. Thank you.
Thank you. Johnny, are we adjourning or are we adjourning into closed session?
There's no closed session.
Great. In that case, in memory of Captain Crow, the meeting is adjourned.